Hello and welcome to this RSM webinar. We're looking at cash flow generation through the use of tax reliefs and reclaims during these difficult and fast-changing times. The information being presented to you is correct as of the evening of April the 21st, and indeed as more information and guidance becomes available, it will be shared with you via the RSM Coronavirus Hub on our UK website. So that's rsmuk.com. This is our third series of RSM webinars related to coronavirus. We have previously produced webinars on the Job Retention Furlough Scheme and workforce costs, and another series on funding and the Coronavirus Business Interruption Loan Scheme. Recordings of both of these series are available on our website. We will be recording this webinar, and it, along with the slides, will be made available to everyone who has registered for this event. In terms of housekeeping, please do check that you have muted your microphones. We have tried to do everything centrally, but if you could just check your own microphones, that would be immensely helpful so that we can reduce distractions. And indeed, as we are all home working and relying on broadband connections, please do bear with us if any technical gremlins creep into this presentation. Now, we do want this webinar to be as interactive with your questions as possible, so please do use the Q&A function, as you can see on the screen, in order to send in your questions. As time's permitting, I will ask our presenters as many of your questions as we can this afternoon. So in terms of your presentation team today, I'm pleased to introduce James Morris. James is a specialist corporate tax partner. Unbelievably, looking at his photo, he has 20 years experience across a diverse number of business sectors. We're also joined by Peter Graham. Peter is our RSM National Head of Capital Allowances. He leads our national team specializing in this niche area, and it includes tax advisors, accountants, surveyors as well. Next up is Phil Munn. Phil is a specialist VAT partner who heads up one of our regional VAT teams. Phil has worked in industry with particular experience in the TMT and leisure sectors. He tells me that he has two very loud daughters who may well feature in his presentation later. I hope not, Phil. And then finally, James Tetley. James heads our innovation and technology practice, focusing on R&D claims, patent box, and creative sector reliefs. He is a tax partner working with businesses from main listed markets through to pre-revenue generation university spin-outs. And my name is Simon Hart. I'm RSM's Knowledge Management Partner, and I will be our host for today. So in terms of our agenda, as you can see, we will start with corporate tax and reliefs before moving on to research and development claims, followed by capital allowances, and concluding with VAT deferrals and VAT planning. So without further ado, let's kick off with James Morris and corporate tax opportunities.
Good afternoon, everybody, and thank you, Simon. I'm James Morris, and I suppose in these uncertain times, cash is an integral part of a business strategy. So corporation tax payments are often a significant outflow for a business and have a significant impact on cash flow. So over the next few slides, I'm going to consider some methods of managing these cash flows, either through deferrals, permanent tax savings, or through generating repayments. So on this slide are a number of areas that we will consider over the course of this presentation that are important to a business when they're looking to manage their corporation tax liability. Some of these I'll be picking up: loss carrybacks, quarterly instalment payments, claiming overpayment of tax, and reviewing historic tax positions. And then James and Peter will cover some of the other areas. So I guess the first area I wanted to pick up on was what to do where you think you've paid too much tax. So how can you manage your corporation tax liability and either cash payments that you've made or you are due to make? So I suppose there's three scenarios that I've considered here. The first is where you made a loss in your last accounting period and a profit in the accounting period before that. The second one is where you've been making current year tax payments or are due to make some, and you need to reconsider the payments that you're due to make due to a change in your current year forecasts. And then finally, what about the situation where you made a prior year profit, but in the current year, particularly due to the current situation, you are forecasting to make a loss? So if we think about loss carryback claims first, and let's use the example of a December year end to illustrate this. If you were tax paying in the period ended 31st December 2018, and then you had a loss-making period ended 31st of December 2019, you could include a claim to carry back tax losses to 2018 within your 2019 corporation tax return. So that would mean you didn't have any corporation tax to pay in 2019, but you also generated a repayment for your business of corporation taxes that you'd paid in respect of 2018. To do this, however, you need to be able to file your tax return. And to file your tax return, you will need signed accounts, and that in itself may be difficult in the current environment. It's also unlikely that any COVID-related losses would have crystallised for periods with signed accounts. So I suppose the question is, what else can you do? Well, firstly, if you've upcoming tax payments, particularly under the quarterly instalment payment regime, it's really important that you review your forecasts. Most businesses that have been impacted by the current crisis will have been reforecasting and running various sensitivities and analysis. So just remember that your quarterly instalment payments are based on your best estimate of the outturn for the year. So if you have various sensitivities, don't always assume your corporation tax payments should be made on the most optimistic forecast. And I guess then consider whether any further payments are required at all. And if you've already made quarterly instalment payments and now think you've paid too much, you might be able to ask for a repayment from HMRC. So we've had quite a bit of success over the last few weeks in doing this, and the revenue are generally pretty receptive to issuing a repayment where your forecasts have changed. And I guess finally, I wanted to think about, what about if you are in a year where you forecast you will make a loss at the moment, but you haven't yet finished the year, and so you're not in a position to file a corporation tax return and make a loss carryback claim, but you did pay tax in your last accounting period. Well, you might still be able to approach HMRC for a corporation tax repayment on the basis that a loss carryback claim from the current year is anticipated, and there was some specific legislation that was brought in, temporary legislation during the financial crisis to permit this. Now, nothing similar has been introduced yet, but the revenue have been approached and have made some repayments. It's not clear-cut that there's a legislative basis for this. However, so it's a bit more complicated. So I'd suggest speaking to your usual RSM contacts if you think this is something that is of use to you. The next topic I wanted to pick up on is time to pay arrangements for established corporation tax liabilities. So if, as a result of the current coronavirus situation, you're finding your cash flows are a bit tight, HMRC are willing to engage with businesses through their dedicated helplines or through the customer relationship managers if your business has one of those. Recent experience is that HMRC are granting a 3-month deferral when you articulate to them that your business is experiencing cash flow stress due to COVID-19. But you will need to put a formal payment plan in place and agree a timetable for repaying any corporation tax that you defer. Finally, before I hand over to James, I wanted to mention revisiting historic tax positions. So I suppose quite often when you file your corporation tax return, you're either running up against deadlines, so it's difficult to get the information. You might be short of manpower and find it difficult to kind of do the full analysis of some areas in your tax return, and sometimes that means that you adopt quite a prudent position, and that can mean that you end up paying a bit more tax. And when cash is plentiful, that's probably not the end of the world, but I suppose now in the current environment, is there an opportunity to revisit positions that have been taken in the past? So I've highlighted a few common areas here that are worthy of consideration. Capital expenditure I won't cover because Peter will touch on that shortly. but a couple of other areas. So transaction-related costs, so either property transactions or M&A related transactions. Particularly with an M&A transaction, so an acquisition or a disposal, if you've got any costs that have gone through your profit and loss account, quite often these are disallowed, but they can, within that pot of costs, be stuff that is allowable from a corporation tax perspective. Quite often you find things like recruitment costs for non-execs, new management, etc. Those would all be allowable, and similarly any costs of raising debt finance could be tax deductible as well. So if you identified any of those, you have the opportunity to amend your prior period tax return, and you could claim tax relief even if you've already filed it with a disallowance in there. Some similar basis with reviewing legal fees. If you've disallowed legal fees from a particular law firm, but actually there's been a number of strands of work undertaken, have you actually kind of gone through the analysis of time incurred, and is there any allowable costs in there? Miscellaneous costs, sometimes these are, or sundry as they're sometimes called, sometimes it's just difficult to analyse them. Sometimes it's just not seen as worthwhile to kind of sit there and go through looking for what's in there. And if you've taken the prudent position and disallowed those costs, is it worth revisiting them now and having to think about whether any of it's tax deductible? And the final point is around provisions. And revisiting kind of disallowances that have been made, maybe a general bad debt provision or something like that. Is it really general in nature, or is it specific in nature? Is there a basis on which you've determined that provision's value? I mean, if there is, then it probably errs more on the side of specific. And if it's specific, then as you've accrued it, you potentially able to claim a tax deduction. So certainly worth revisiting that. And at that point, I'll hand you over to James.
Good afternoon. Today I wanted to highlight how R&D tax relief and other creative tax reliefs can support businesses by delivering much needed cash in the current environment. I'll talk about the value of these reliefs and what businesses can do now. I'll also explain in brief the activities that qualify, and we'll finish with some very specific updates on claims being made as we speak. Many will already be familiar with the R&D tax credit schemes, which are a well-established incentive delivered through the tax system that supports businesses that are innovating, taking risk, challenging existing approaches, and developing new knowledge, whether this be industry-leading or for their company alone. However, now more than ever, it's well worth revisiting this area to understand whether, in tandem with other approaches discussed today, it's an opportunity to ensure your business is maximising all available opportunities. First of all, what's the value? There are two schemes within which R&D claims are operated: the Small and Medium-Sized Company Scheme, or SME, and the R&D Expenditure Credit Scheme, or RDEC, for large businesses or SMEs that in some circumstances are precluded from claiming under the SME scheme. For SMEs, the value of the relief is 33p for every £1 spent, where the company is not tax paying and claims a repayable credit. If the claim results in a repayment of tax paid or reduced liability payable, it's at a rate of 44p per £1 spent on qualifying costs. And under the RDEC scheme, the value is a little over 10p per £1 spent, and that's since 1st of April 2020 when the rate increased. So under each scheme, a valuable cash contribution. Big question, what can you be doing now? Well, firstly, if you finalised your audit or financial statements, then can you be accelerating the usual process of preparing your claims to bring forward likely cash repayments? You may have technical or operational teams with more capacity to support currently, where sites are currently on restricted operation, and these individuals are usually important in scoping these claims. If you haven't historically made claims, I'd recommend that it's worth critically considering whether making such a claim is possible. Equally, if you're a long-time claimant, when was the last time that you challenged your existing methodology? These often become stale and compliance-driven over time, so a fresh pair of eyes is always valuable. And in an overlap with capital allowances that Peter will pick up shortly, if you have incurred capital spend on R&D assets, equipment, laboratories for example, have you made claims for 100% R&D capital allowances? I won't go through all the text that you'll see on your screens now, but here are a number of questions to ask yourselves if you're looking to evaluate whether a claim is appropriate for your business. For me, the most important point is to distance yourself from the day job. When you're doing it each day, it's easy to forget how innovative and impressive the work you do really is. It's just what we do is something I hear time and time again. Ask yourself these questions rather than the first one, am I doing R&D? And if you answer yes to one or more, you should consider this further. But at its heart, the R&D legislation is based around two cornerstones. It's where a project seeks to achieve an advance in science or technology, and in doing so requires the overcoming of scientific or technological uncertainty. You need both the advance and the uncertainty to qualify. But once you've satisfied these conditions, activities which directly and indirectly contribute to this will qualify. An advance can be in a process, material or service, not just products or devices, but must represent an appreciable improvement over what's gone before. It can also duplicate an existing effect more efficiently, for example, reduce cost, smaller or less wastage in the production process. Again, I won't go through this slide in detail, but this slide explains the point that I made at the outset around the values of the two regimes, the SME and the RDEC regime. An SME for these purposes is defined as a company or group with fewer than 500 employees and either 100 million turnover or less, or gross assets of less than 86 million euros. Where a company has investment from private equity or venture capital, this can impact on a company's status, so it's well worth considering in detail. Another slide here for your reference really, but sets out the types of qualifying costs under each scheme. Under both, categories of qualifying expenditure include staff, materials consumed, software, heat, light and power, externally provided workers or agency staff, and clinical volunteers. Under the SME scheme, subcontract qualifies as well, whilst under the RDEC, contributions to universities will qualify. And although we've spoken in some detail around R&D tax relief, there's a whole suite of other innovation-based tax reliefs that can generate improved cash flow. These include the patent box, which offers a reduced rate of corporation tax of 10% on profits from qualifying intellectual property, and also 8 different creative industry tax reliefs that you'll see on your screen, which are generally worth in the region of 20p per pound spent. But finally, I wanted to cover some live questions that I've been discussing with HMRC in recent weeks. Firstly, HMRC are open, working remotely and processing claims in general within 28 days of submission. Claims must be filed on time. Covid-19 is still no excuse for lateness. And a claim needs to still be submitted with signed accounts. So this may cause issues for any businesses that are having difficulty signing off an audit. And finally, R&D repayable amounts will be repaid if you have agreed a deferral of other taxes with HMRC, for example, the VAT deferral scheme. HMRC processing teams have been directed not to offset the two. This is in contrast to a time to pay arrangement. A deferral means the liability isn't due, whereas a time to pay is an acknowledged liability for which extra time is being given. So whilst deferral won't impact on your repayable credit, if you have a time to pay arrangement, you will likely find the R&D repayable is taken to reduce amounts due under the time to pay. But I'd finish by reiterating the first point made, that these reliefs generate valuable cash. We understand that as management teams you're facing a daily onslaught, but this is an area that can deliver real value and can do so in a fairly short period of time. But I'll now hand over to Peter, who's going to talk you through some of the reliefs available under the capital allowances legislation.
Thanks, James. As James said, the capital allowances and R&D teams have been working quite closely on a number of projects. So if anyone is out there on the webinar, they've incurred capital expenditure and also carry out R&D, then it's definitely worth getting in touch with us to look at that expenditure jointly to make sure we maximise both tax reliefs. So good afternoon, everyone. This is certainly a new experience for me today. I do really enjoy giving presentations, but normally I have a lovely audience of smiling faces in front of me to give me some positive affirmation to make sure I'm doing okay. So I'll just assume that that all is well out there and everyone's enjoying the presentation. I did try and persuade my wife and kids to be the audience, but apparently the subject matter wasn't something that was exciting enough for them. So I'm going to spend the next 9 minutes talking about how we can unlock cash through 2 further tax reliefs, capital allowances and land remediation relief. The area of capital allowances that I'm going to explore is historical capital expenditure on commercial property. Now, this can be commercial property that's been bought, built, refurbished, or fitted out. And it has to be commercial premises. Just to clarify, commercial premises are premises that are not residential. Now, oddly, commercial premises does include care homes, student accommodation, and also you can claim capital allowances on the common areas of apartment blocks. So it's slightly wider than it might first seem to be the case. And if you're unsure about whether your property is a commercial property and might qualify, then please do get in touch. The commercial property can be freehold or leasehold. So if you're a tenant and you rent the property, you can still claim capital allowances on the money that you spend fitting out the property. For those of you listening that have not come across capital allowances before, to give you a bit of the basics, capital allowances are a tax relief given when you incur capital expenditure on plant and machinery in your trade or business. This allowance is deducted from your accounting profits when you're calculating how much tax you need to pay. Now, for 2019 and 2020, the tax relief is very generous, as they have increased the amount in which you can claim 100% tax relief, and this is up to £1 million worth of expenditure. So in 2019 and 2020, you can claim up to £1 million, and then also a proportion of the expenditure over that amount. Previously, this 100% first-year allowance was only £200,000, so it's a good time to consider a capital allowances review. Now, there are some obvious items that I'm not going to go through today in terms of qualifying for capital allowances. They are movable items, which are desks, computers, cars. These are things that are easily identified, and most people pick up the tax relief that's available on them as a matter of course. There are also immovable items of plant and machinery within commercial property. These become embedded within the property, and this is the area which I'm going to explore with you today. So to give you an example of the types of plant and machinery that includes, it's lighting systems, air conditioning systems, boilers, etc. So when you're buying or building a property, you can claim capital allowances on typically 15 to 30% of the purchase price or construction cost. So it's quite a substantial amount of tax relief available. And for a refurbishment or fit out, the percentage that qualifies is even greater. It can be somewhere between 50 and 90% of the total spend that will qualify for tax relief. I'm just going to discuss a recent case study of a review that we've carried out for a client. It was a crazy golf business, and our client had incurred £6 million worth of capital expenditure across its sites. Now, these are a mixture of freehold and leasehold properties. With this review, an initial claim had actually been carried out by their existing advisors, but they still wanted to get us involved to see if there was anything we could do to increase that claim, and there certainly was. Our specialist team of dual qualified surveyors and tax advisors used a forensic approach to review the spend, and they managed to identify an additional £1 million that qualified for tax relief. Now, this is over and above the original claim. So this generated additional tax savings for the company of nearly £200,000. And this review encompassed a site visit to the various properties they owned, and we managed to complete the review in 6 weeks. In terms of who can claim capital allowances, as long as you are an entity that pays UK tax, so a company, an LLP, an individual, or a trust, then you are able to claim capital allowances. It also applies to non-resident companies who own UK property. The property has to be held as an investment or owner-occupier, so basically on the balance sheet of the company or LLP. And as I said before, it has to be commercial property. In terms of some of the key takeaways when it comes to capital allowances, there are a few myths out there that are worth mentioning and hopefully correcting people's understanding of those. The first one is that capital allowances do not expire. So as long as you spent money on a property and the expenditure qualifies and you still own that property, you can claim capital allowances. We've carried out claims on property expenditure incurred by our clients up to 20 years ago. All you have to do is include the claim in the most recent open tax return. When we carry out a review, we ensure that all available tax relief is claimed and captured. So as was mentioned by James and at the start of my presentation, we also consider if there's an opportunity to claim research and development capital allowances, which can be very lucrative, where you can claim 100% tax relief on the actual building structure. Lack of historical detail, that doesn't preclude us from making a claim either. As I mentioned before, we have specialist surveyors in our team, and they can evaluate a claim based on a site visit and their quantity surveying skills and knowledge to be able to work out the value of that claim and agree that with HMRC. The previous case study that I discussed demonstrates that even if claims have been carried out previously, it's still well worthwhile reviewing those claims. If you've not claimed tax relief on 100% of the spend, it's certainly worth having a look to see if that can be improved, as was the case with the Crazy Golf business, and we identified an additional £200,000 worth of tax savings as a result of that review. Just moving on to land remediation relief. This is another area that our team helped to generate cash flow and cash repayments for our clients. The land remediation relief is a relief for corporation tax only, so it's only available to companies. Now, there is a scenario if you have an LLP which has a company as one of their members, the company that is above the LLP can, in fact, claim land remediation relief. This is a super tax deduction, which is 150% of the qualifying expenditure. And it's when it's incurred by companies in cleaning up contaminated land and buildings. And one of the key tests is the property has to have been acquired in a contaminated state. And if you're, in fact, a loss-making company, you can still benefit from this super tax relief. You can actually surrender some of your losses generated as a result of the land remediation relief claim to generate a cash repayment equal to 24% of that spend. As I've mentioned, qualifying expenditure, that is remediation of contaminated land, including things like asbestos removal, breaking out buried structures, treatment of harmful organisms or things like Japanese knotweed, radon and arsenic, and even encapsulating the contaminated material that's on the site. There's often a claim that is carried out by property developers. So it isn't just for investors, it also includes developers who can benefit from that. And most of the claims that we've done to date are for UK property developers. In terms of the type of costs, things like staffing costs, professional fees, on advice how to remove the contamination, also any proprietary activity, any materials that you've used to clean up the contamination, all of these type of costs qualify for this tax relief. There is a time limit. Retrospective claims can be made for up to 4 years. This is where the claim can be split into two. If the expenditure has been capitalized, the time limit is 2 years from the end of the accounting period in which you incur the costs. But for costs that are charged through your profit and loss account, the time limit is extended to 4 years. Now, just to cover off a very simple example, this is based on a claim that we've done for one of our clients. A property investor company who bought an old foundry building and wanted to convert it into modern manufacturing facility available to rent. Part of the conversion costs were the removal and safe disposal of an asbestos roof at a cost of £200,000. The company is able to claim £300,000 worth of tax relief, which saves them £57,000 worth of corporation tax, based on the current rate of 19%. Now, this company was tax-paying and was able to reduce their tax bill, but even if it was loss-making, they still would have benefited from £48,000 worth of cash repayment, as they would have been able to surrender those losses for a cash repayment. Now I'm going to pass over to Phil, who's going to talk through some VAT cash flow saving opportunities.
Thanks, Peter. Good afternoon, everyone. As Simon mentioned, my name's Phil Munn, and I'm a partner in RSM's VAT team. I'm going to spend a few minutes now talking through the government's VAT deferral scheme, and then touch on some of the VAT-centric cash flow improvement measures that we believe organisations should be considering at present. So the Chancellor's announcement of the VAT deferral scheme on the 20th of March was just one of a series of unprecedented measures the government had introduced to support organisations through this period. At a high level, the scheme defers any VAT due to HMRC between 20th of March and 30th of June 2020 until the 31st of March 2021, without incurring any interest or penalties. It has been estimated that £30 billion of government VAT receipts could be affected by this measure, albeit taxpayers are not obliged to take advantage of this scheme. One of the most commonly asked questions by organisations since the announcement is which payments will be affected by this measure. To illustrate the point, an example may be easiest. If your quarterly VAT return period ends on the 30th of June, i.e. within the deferral period, your VAT payment is due on or before the 7th of August, outside of the deferral period. In this example, because the payment due date is outside the deferral period, the VAT must be paid to HMRC by the usual deadline. Unless, of course, a time to pay agreement has been reached with HMRC, as James Morris noted earlier on. There are some important exclusions from the scheme. UK VAT due under the mini one-stop shop must be paid on time or under the usual time limits. In addition, VAT assessments made by HMRC against taxpayers prior or during the VAT deferral period remain due to HMRC, and import VAT due to HMRC when goods enter the country into free circulation must still be paid according to the usual rules. As an aside, on the import VAT point, I note that those organisations with a VAT or duty deferment account were entitled to request an extension to the payment due date of the 15th of April. It remains to be seen whether there will be an extension offered to payments due from this group of taxpayers on the 15th of May. And for the avoidance of doubt, other indirect taxes, some of which are listed on this slide, are not included in the deferral scheme. So we've got insurance premium tax there, aggregates levy, they're not included within the deferral scheme. However, if you are worried about being able to settle those taxes, they may form part of the time to pay agreement, and again, that's something that James touched upon a little earlier. Just two more notes from me on VAT accounting during the deferral period. First of all, VAT returns must be submitted in accordance with the usual rules. While VAT payments may be deferred, VAT returns must continue to be submitted. Second, if you wish to take advantage of the deferral scheme, direct debits established to settle VAT payments must be cancelled. Please take care to ensure that other direct debits with HMRC, for example VAT deferment account payments, must remain in place to avoid late payment or other tax that may be due to HMRC. So there are a variety of direct debits that may be established, and making sure that you get the right one is absolutely key. I should say that the time to pay helpline in the event of sort of VAT assessments and things like that will be open, and as James mentioned, they are exercising their discretion at the moment. If we go to the next slide. Brilliant, thank you. Aside from maximising the benefits of the deferral scheme, VAT has an important part to play in improving your organisation's cash position. I don't have time to go through all of the measures now, and I would encourage you to speak with your usual RSM contact and keep an eye on RSM's Coronavirus Hub on the internet to keep track of some of those cash improvement positions. Having said that, I will touch on some of the more commonly applicable approaches very quickly now. First and foremost, it's worth realising that the deferral scheme defers VAT due to HMRC, but it's still possible to reclaim VAT from HMRC. Therefore, for those businesses or organisations that submit VAT repayment returns, it's worthwhile getting those returns in as quickly as possible. Our experience suggests that Revenue and Customs are repaying those VAT returns very, very promptly in fact, more promptly than usual during what might be a very difficult period for some businesses. So get those repayment returns in quickly. On a similar vein, EU VAT refunds are usually due slightly later in the year. We remain part of the EU for VAT purposes until 31st of December, subject to any extension to the transition period. Therefore, a relatively straightforward online refund mechanism is still available to UK businesses seeking to recover EU VAT. The sooner you get those refund claims in, the chances are the sooner you will get those refunds processed. Again, going back to those repayment traders or organisations that recover VAT from revenue and customs on a regular basis, if you are on quarterly returns, it might be worth considering going onto monthly returns. Clearly, this must be balanced against the additional compliance costs, but the improvement in cash flow from reclaiming that VAT might be quite useful at the moment. Businesses or organisations that import goods from outside of the EU, it might be worth considering establishing a deferment account for VAT or duty, or indeed establishing a customs warehousing arrangement to ensure that import VAT and duty is paid at the last possible moment. I would say that with deferment accounts, a bank guarantee will be required, and of course with customs warehousing arrangements, there can be considerable costs associated with those types of arrangements, but they need to be balanced against the cash flow benefits that might otherwise arise. Last but not least, and a very practical point, this final one, it's quite common for suppliers to issue invoices towards the end of a month in accordance with monthly billing cycles. What often happens, we find, is that those invoices that might be raised on, let's say, the 30th of June, often aren't processed by the accounts payable team of the recipient until the middle of July or even towards the end of July. Now, that means that they may fall into a different VAT return period. So what we're talking with a few of our clients at the moment is quite forensically going through their perhaps larger purchase invoices to ensure that VAT recovered on costs is recovered in, if you like, the right period and as early as possible, again, as a means of releasing cash into the business as quickly as possible. So in the meantime, the deferral period for those businesses that are taking advantage of it, what can we do to prepare for the end of the VAT deferral period, which, as I mentioned earlier, is scheduled to end on the 30th of June? Well, for landlords, particularly commercial property landlords, they might consider issuing requests for payment rather than VAT invoices to their tenants. The issue of VAT invoice will create a tax point, which means there is an obligation to pay the associated output tax to HMRC, subject to the deferral, of course. You might consider issuing a request for payment instead. That request for payment doesn't create a VAT tax point, and that means the tax point arises at the point at which your tenant pays the rent, or indeed a VAT invoice is raised, whichever comes sooner. That obviously provides a little bit of bad debt relief for the VAT element of any late payments, and those requests for payment might also apply to some other service providers, and therefore provide some output tax cash flow improvement. I would add that those requests for payments have important commercial and process implications, so it's not something that you should enter into lightly. Nonetheless, the benefits of that particular scheme are very valuable at the moment. Last but not least, I just want to say a word for those larger businesses or organisations on the call that might be in the payment on account regime. This is where even if you're on quarterly VAT return periods, you have to make a monthly payment against your VAT liability. That monthly payment is calculated against historic trading patterns, and of course there is an expectation in some industries that trading patterns will be negatively affected by the coronavirus, and so it's possible to renegotiate the value of those payments on account for periods after the deferral scheme has ceased, and thus provide an important cash flow benefit to those larger businesses with payments on account. That renegotiation process is somewhat complex and requires some sort of careful cash flow forecasting, but I think it would be true to say that most organisations are going through some form of cash flow budgeting at present. So it should slot in nicely with those calculations. That's all I really wanted to say on the VAT side of things. I'll hand back to Simon now to take questions.
Thanks, Phil. I think everyone will agree, Phil, that you've got a very therapeutic radio voice there, so you are available tax-free, I believe, for radio shows if anyone needs any voiceovers. Okay, let's start with some of your questions, and thank you for sending them in. In no particular order, I think James Morris, this is a question for you. Can you offset any tax reclaims that are sent in now against upcoming tax payment liabilities?
Thanks, Simon. And the answer is yes. HMRC's default position will be to issue a repayment to you. But if you know you have an upcoming liability that needs settled, you can inform HMRC that you'd rather have a repayment set against an upcoming liability and use it almost as a payment on account to do that.
Okay. Phil, a question on VAT. Do you still have to pay the payments on account for VAT if they fall due between March and June's quarter?
Yes, any payments on account due between that 20th of March and 30th of June window that I mentioned earlier on can be deferred. Again, it comes down to the individual taxpayer's preference, but they can be deferred until March next year.
Okay, and another VAT-related question, this time in connection with direct debit. So if I fail to cancel a direct debit and the payment's gone now, can I take advantage of the VAT deferral and can I get a refund of that cash payment?
I think in this case, so first and foremost, it's worth making sure that that direct debit is cancelled immediately. In terms of clawing back VAT that might have been inadvertently paid, I think the best course of action here is to speak with your usual RSM contact, or alternatively, try to get hold of HMRC through the helpline, which is open from 8 AM through to 4 PM. We can give you the numbers after this webinar if that would be useful. I would, just a word of warning more than anything else, all of the HMRC helplines at the moment, I can't speak for the tax ones, they are very busy at the moment answering questions on the deferral scheme, amongst many other things, so be patient.
Yeah, I mean, that's hardly surprising. I think HMRC, as well as most of the government agencies, their call centres are particularly busy. But in terms of the actual claims being processed, are we seeing, how much of an extension of time are we seeing in terms of those claims, whether it's capital allowances, R&D, etc., and what can be done to speed that up?
I'll answer on the VAT side of things. Our experience is that provided Revenue and Customs have the information they need, the repayments are being processed quicker than usual, actually.
Right, okay. What about on the direct tax side, chaps?
Yes, on the R&D side, we're seeing around 95% of all claims being repaid within 28 days, which, similar to Phil's experiences, is better than you would usually expect.
Okay. All right. Sorry, go on, James.
I was just going to say, it's also worth noting that automated claims, so claims that are included within a return that hit the revenue systems and flag a repayment, are getting repaid faster than those that are a more manual claim process. And in those cases, it becomes a lot more important to engage with HMRC and make sure it doesn't just get lost in a pile of post.
Yes. I'd like to say something. Ilan Raja, Scan Computers. It's not a question, but just a thank you. Because we worked with you on R&D, we had a 620k credit, we put it into our corp tax return, and it was settled in 14 days. Unbelievable. Thank you.
Excellent. That's really nice to hear.
You took me by surprise there, but thank you very much for that. Okay, next question. can losses arising as a result of an R&D claim in financial year 21 be carried back to financial year 20 to offset against trading profits for a refund rather than a tax credit? James.
Yes, good question. So if you imagine last year that you surrendered your losses generated from your R&D claim for a 33p cash credit, what you can now do is revisit that original claim, give back your 33p cash credit, and by carrying back your losses from FY21 to FY20, you can reclaim a repayment of corp tax of 44p in the pound.
Okay. Say that one again, James. I missed the end there. Sorry.
So effectively, I think the question is asking, can you, with the benefit of hindsight, can you revisit an original claim for a cash credit, which is at a slightly lower percentage, and remake a claim for a repayment of corporation tax? The answer is yes, you can. Provided you're within your statutory time limits to do so, you can revisit that on the basis that the repayment of corp tax is at a better rate than the outright repayable credit.
Got it. Okay, let's move on to another question. This one's more of a practical question. Peter, this one's for you. With site access restrictions at the moment, how are you actually able to deal with surveys for capital allowance claims?
So a survey is something that we tend to do with all of our capital allowances claims to make sure we pick up all of the kit in the building that qualifies, but it's not necessary in order to finalise our claim and submit it to HMRC. So what we are doing at the moment, we are finalising our claims and submitting them to HMRC, and then carrying out a site visit at a later date and revising any claim to improve that if that is the case. So it doesn't stop us from doing our work or filing our claims.
Right. Yeah. So the point there is if you're thinking about capital allowance claim and you're concerned about the practicalities of it, don't let that stop you make the claim. Fine.
Absolutely.
Great. Okay, Phil, I think we've got another VAT question here. If the company is in a net repayment situation for each return, can they separate out the reclaim on the purchases and reclaim that, and defer the amount payable on the sales so that the reclaim is larger? I like the idea. Not sure it could work.
I mean, I feel like I need to offer somebody a job. No, I'm afraid not. If the VAT is due on the sales, then it must be offset against the tax. I presume that the period is identical for both the VAT due on the sales and the VAT reclaim on the costs. But those must be offset in accordance with the usual rules.
Understood. Okay, here's a capital allowances question. If we have invested in capital computers technology for COVID-19 home working, does this qualify for capital allowances?
Yes, it does. So provided the assets being used in the business, which it will be for to enable people to home work, then yes, it will qualify for capital allowances.
Okay. Are there any plans for HMRC to change the revision to quarterly payment plans to avoid companies potentially having to pay 6 instalments in one financial year? James M?
Yeah, so I think this is talking about the change for accounting periods commencing after 1 April 19 for very large companies. So those with taxable profits of more than 20 million would be required to accelerate their corporation tax instalment payments. And if you're a December year end, this year is a transitional year where you end up with 2 payments for your December 19 accounting period and 4 payments for your December 20 accounting period due this year. I think the revenue's view at the moment is no, because to fall in it, you need to have profits of more than 20 million, albeit that is divided by the number of companies in a group. But I think the view is still, if you are making profits and forecasting to make profits, the revenue would rather that you paid it. However, that being said, from a practical perspective, the quarterly installments are only based on your estimate. So if your estimate is in a worst case scenario at the moment and that you don't end up making any accelerated quarterly installments in the first half of this year and then making a catch up later in the year, the interest rate that HMRC charge you is relatively low at the moment. So the actual cost of kind of deferring the payment based on kind of forecasts is relatively cheap.
Understood. Phil, VAT question. Can just to clarify something you mentioned in your presentation, can VAT payments can they be deferred until effectively 31st of March 2021, therefore?
Yes, if the VAT payment is due by virtue of a return that was submitted, and it would ordinarily be due between the 20th of March and the 30th of June, they can be deferred until the 31st of March 21.
Okay. James T, here's quite a technical question for you. Good luck with this one. And Matt, thank you for the question. It's an R&D question. We have a substantial claim to make for financial year 21. We didn't make a claim in 20. During 21, we completed a PE-backed MBO, which I believe may result in a change of our status from an SME to large company. Is the claim split on a time basis, or is the claim limited to a large company rules only?
Yeah, it's not a great question. So the short answer is that if there is a change in status, it will happen for the whole period. So it's not time apportioned pre or post deal. If the deal happened in that year, then for that year, you are either SME or large. The more complex question is whether you have actually become large as a result of that PE-backed MBO. And that's not an easy one to answer. It's probably one to pick up offline. It looks into the detail of control, whether the PE entity or the investment vehicle that the PE entity has used has taken control. And if you effectively need to aggregate your size with all of the other portfolio companies within that particular fund of the PE house. But I think that the first question is probably the easier one, that it is an immediate change if there is a change to be made.
Okay, well done. Another R&D related question. Is the definition of what qualifies for R&D relief the same as for capital allowances and for tax credits?
Yeah, it's really the perfect sort of middle bit of the Venn diagram between capital allowances and R&D. So when you're looking at R&D capital allowances, the asset has to be used for R&D purposes, and that R&D definition does track back to the R&D tax credit rules.
Great. Thank you very much for that. Okay, I'm just conscious of time, everyone. I think we've been through all of the questions that are coming in at the moment. I'm just having a quick scan. Yeah, I think we're there. So look, I just wanted to thank you all for those questions. There's some really great ones in there, and I just wanted to yeah, there isn't any more coming in. Sorry, that's fine. Yeah. So yeah, thank you very much for those questions. So in terms of what's next, if we could just move the slide on one, we've created a central email address for any queries that you've got relating to this topic, or indeed our other issues around furloughing, fundraising, the government business interruption loan, etc. So if you've got any detailed questions or queries, please throw an email into the COVID-19 inquiries at rsmuk.com, and do visit the Coronavirus Hub, where you'll find a lot more information that we've prepared, and we are updating pretty much as it happens as new information is released by the government agencies. And you'll find recordings of our other webinars on there, and this one will be up as a recording shortly. Also, in relation to receiving information from RSM, if you could also go onto the website and choose your preferences, just to make the experience of information that you're getting from us more tailored and more specific to you, your needs, and your own organisation. So you just go onto the preferences part of the UK site. So thank you very much for that. All that leaves me to do is to thank you for your time this afternoon. That concludes our webinar. Please look out for more information on future events and future webinars. But on behalf of James, the two Jameses, Peter, Phil and myself, and the whole of RSM, thank you very much for your time and your attention and your questions. And the very best of luck to you, your families and your businesses during lockdown. Thank you very much.